Our focus today is reflecting on efficiencies from the recent energy cycle, and obviously that's where we should start. So we know that the Canadian energy sector over the last 8 years has become leaner and meaner, greener too. I guess, how have some of the changes we've been seeing really, essentially that period of hardship changed the industry moving forward?
Mhm.
And I'll throw it to Brian first.
Yeah, because at COVID, during COVID, we had a really a long time to really think about strategy and where we're headed. And I think the shareholder base changed a lot. Obviously, the price of oil was quite suppressed. We did okay through COVID because we had a good balance sheet and we did some hedging that kind of kept us in around the $65 range. So, but it did really cause us to take a look at our entire business. The buy side had changed a lot. There was the energy specialists were dropping out of the space. The generalists were taking over the stock, and that meant that you're going to be compared to other industries. Things like pharmaceuticals and industries that we're not used to be compared to. Really changed the way that we our strategy going forward, taking a lot longer term view of the business, making sure you were sustainable, repeatable, that people could see a horizon, that the advent of free cash flow and return of capital to shareholders. All that was quite predictable if you really took a good hard look during COVID.
And Rodney, even if we look back at the last decade, obviously 2012, when we saw the price of oil doing very well, is very different from 2022 when we're seeing oil doing well again. How have production costs changed in these last 10 years?
Well, I'd say they've been volatile, much like the commodity price. When we look at 2021 costs compared to 2022, I would say to some extent we were coming off of all-time lows for service costs. Service companies were barely covering their variable costs, let alone generating return on their capital. And when we look at 21 costs to 22 at Baytex, we're probably seeing an increase of 15 to 20% on capital in Canada, and probably pushing closer to 25 to 30% on our U.S. operations. Yeah, our operating costs in particular would probably be to the lower end of those ranges, both in Canada and the U.S. And really driving these costs is really the input costs to our business, which are closely tied to our energy prices. So costs for steel, chemicals, electricity, fuel, and labor have all increased similar to other industries. So, we try our best to level load our capital programs to offset some of the activity-related inflation, and also help our service providers plan for activity levels. So this helps with procuring long lead time items and maintaining qualified and experienced staff. And to some extent, we also don't get the industry competing or encouraging service company growth that maybe isn't required full cycle.
Rodney, on that, I did hear that Baytex was anticipating 15% in terms of those inflation costs this year over last. Do you expect that to ease at all in the near term?
Some of that. I think there's been some probably supply pressures, supply chain pressures that have maybe pushed that. We've also seen the commodity price come off quite significantly. And you're not seeing activity levels that are increasing that you would have maybe seen in historic cycles. So they're really, maybe to Brian's point in terms of what's changed with companies. When we look, companies are laser focused on capital discipline and generating shareholder returns. And historically, there may have been a propensity to grow production and reserves, whereas people are really looking at full cycle returns, generating those returns, which is in turn, going back to the shareholders, whether it be by dividends, share buybacks, or debt repayment.
Okay. Brian, when we think about the cost per barrel, we know those costs have been coming down. What is that for your company?
Yeah, so that's a good point, because the repositioning during strategy, a lot of companies are doing that, and certainly Baytex on this panel as well. We're both in the Clearwater play, which really drives down your break-even costs. We're talking break-even costs in, for corporate somewhere around $34. For the plays themselves, you might be, Charlie Lake and can get as low as $24. So the REAP, you asked, in your opening, how does this affect? How has it changed through this last cycle? And getting into the good plays is really important for companies, and the down cycle has enabled us to get into to really good plays that drive down those costs.
Well, let's talk about the Clearwater. You're both very much expanding in that area. We know that, this is an area that is very economical. And I guess when we think about Brian and that big acquisition you've been doing with Delta Stream, this is really key to those efficiencies we're finding. Where do you expect to find even more efficiencies in this area?
Yeah, I think for us, buying Delta Stream, you're in the thickest part of the play. And it really does position Tamarack as a Clearwater performer. I think there's a total of 93,000 barrels a day, we think, produced in the play right now, and pro forma we should be around 33,000. So it really does help us and drive down our corporate costs over the next number of years. So we feel very fortunate with this acquisition.
Yeah, and you know what, Rodney, I'll throw it back to you as well. You guys have been expanding there, and obviously technology is key to allowing that expansion in the Clearwater. What has that meant for your bottom line, just in terms of some of this new technology you've been able to utilize?
I'd say I'd probably go back to the cost question in terms of leveraging technology across all of our operations. Like Brian said, the industry was really forced to create efficiencies and look at all of their operation. And it really challenged, call it, the historic way that we ran our operations, but also monitored it. And so we've looked to utilize technology, whether it be sending out our operators to locations of need on a call-out basis versus driving to locations on a daily basis. So really try to use technology where we can. I think when you look at a play like the Clearwater, it really comes down to horizontal drilling technology and being able to control where that drill bit actually is in the formation and staying in formation. And so for somebody like Baytex, we've been doing this for years in terms of our historic Peace River asset development, both in Seal and Harmon Valley. So we've got a lot of experience with this, and we're leveraging that experience in the Clearwater, which Brian has mentioned is just a fantastic asset generating incredible rates of return. And just to put that into perspective, like Brian said, the play itself is probably producing just under 100,000 barrels a day. That comes from probably 40,000 barrels a day at the start of January. For Baytex specifically, we had in Peavine, we had no production at the start of 2021, and we're producing over 9,000 barrels a day there from, probably 20 wells. So it's pretty exceptional. And those wells are generating IRRs in excess of 500%. So it's an incredibly exciting play. And maybe tying it back to shareholder returns, we've actually been able to grow that asset in terms of the production within cash flow. And this year alone, we expect to generate over $80 million of free cash flow just from our Peavine asset. So it's pretty exceptional.
And, just sticking with Baytex, I do understand that you're also spending more when it comes to exploration and production in Viking. Why are you doing that as opposed to in the Clearwater right now, given the lower cost of production there?
No, it's interesting. When we look at across all of our assets, there is some efficiency to be gained to level load operations, and that's keeping you have a operating cost structure, and you've got to keep assets operating to kind of cover that. And when we look across our assets, it's not only when our service is available, but it's the cash flow they generate. And when we look at the Viking, it generates some of the highest netbacks, within North America. So a very strong asset. But the Peavine for us has been an area of focus and growth, and that just tends to be an asset that's unique in that it can grow within its own cash flow. Whereas right now we're maintaining our Viking production at or around about 17,000 barrels a day, and generating significant free cash flow from that asset.
Okay, Brian, I have to go back to you. When we were talking about the Delta Stream acquisition, you said you'd never seen an opportunity like this, and going on to say it positions us to grow from there. Are you looking for more acquisitions within the Clearwater as well?
Well, I think we've been a consolidator of the Clearwater here, and very active. The acquisition of Crestwind. Um, we bought some assets at Spur, Rolling Hills, and of course this one being the large one. And I think people would look at us as a Clearwater consolidator. Nothing's going to happen in the next few months. I mean, our goal is to pay down debt. We took on debt to buy this one, and so we'll be focused on getting that down and getting our enhanced shareholder returns starting up again as quickly as possible. So you can expect some quiet times on the M&A front here from Tamarack. But I think it's important for everybody to understand what exactly the difference is in the Clearwater play. What makes that thing so fantastic? And you're getting your reservoir to deliver to the wellbore by just getting access and drilling meters. And that means you're not fracking. You're just adding length to it. That gives you a tremendous cost advantage because typically when you're in a fracking operation, fracking is half the cost. So of the well DCT. So take that off is amazing. And the other thing that happens when you don't frack is that you don't get the high declines. And so as my colleague at Baytex said, it's easy to build production, and the success they've had in Peavine, I mean, that's been phenomenal there. But the whole Clearwater play, it's easy to build production because you're not having to backfill a whole bunch of declines. And so that's a great play. I think reason why this play performs and is the top play in North America.
I want to pull on one of those threads, and that, of course, is paying down debt. Baytex, Rodney, you've been noting there that Baytex has said it wants to get its debt ratio down to 1 when WTI hits $40 a barrel. How do you think that sets you apart, maybe from some of your peers in the oil and gas sector?
I wish I could say it set us apart, but it's probably bringing us in line with most of the peer group. I think the industry itself has just gone through a significant amount of deleveraging. Having experienced probably the limitations that leverage put on the business, and maybe just speaking to Baytex in particular, we did purchase an asset at the high side of the commodity price cycle, and it's taking us several years to work down that leverage. And we knew that opportunities present themselves, both at the high side of the commodity price cycle, but also at the low. And unfortunately, at the low, we weren't able to take advantage of some of those. So I think more and more the industry is going to run with much less leverage. And that's really, call it lessons learned, but also just to give us more flexibility through commodity price cycles and really drive more of this shareholder return and expected shareholder return go forward.
When I think about efficiencies, one area in which we've seen a lot of efficiencies is in the workforce. I remember speaking to one of the CEOs of the big oil and gas companies back in about 2016 during all of those layoffs, and he was saying that he did not expect the number of jobs we used to have to come back. Where do you guys fall on that? Do you think we're going to see the number of workers that we needed in the oil and gas sector moving forward? Brian, I'll throw that to you.
Well, first of all, if you just talk to office staff, a company our size running, I think we have a total of 100 people in the office, like, man, you wouldn't have thought of that, a few years, a decade ago. So I think software has a lot to do with it, making us efficient here in the office. I think we are better at sharing technologies amongst competitors and sharing ideas and I'm going to give the service sector credit in terms of driving down costs. I think they've introduced new technologies and that's been a very competitive sector, and they've been driving down costs. In the field, it's I think there's a lot of monitoring technology that we're all deploying right now, and remote access, understanding you're not visiting the well every day. Those kinds of simple things have reduced the number of operators for the number of wells. Pad drilling itself has reduced costs, both on the capital side and the operating side. You're going to a battery, one lease that might have 10 wells on it. And so that's driven down costs. So it really has become a very efficient industry. And I think there's a lot to be gained here going forward as well. There's more technology. People talk about how you use drones, how to integrate drones into your work, and so there's going to be all kinds of things I think in the future here.
Okay. Rodney, I'll throw that over to you. What are you seeing in terms of your own workforce at Baytex?
Well, definitely, I think everybody shrunk, but I'd say first and foremost, our greatest asset is our people, and so there's been a tremendous amount of focus on people and staff. I think COVID and the restrictions that were put in place really challenged that and challenged people to do things differently. And like Brian said, kind of leveraging technology. And so whether or not we were monitoring operations remotely or allowing people flexibility from where they're actually working from, I think that's been extremely beneficial. But through the downturn, it was really a push to do more with less. And I think we're being very thoughtful about adding people back to the workforce to make sure full cycle. But also making sure that people have the training and development they need to be successful. And maybe on Brian's point, really with the service industry, they are really an extension of our own operations. And so making sure that they are well capitalized and people are trained up in terms of safety and our, call it, culture around safety is very important to us because it's reflective of the industry overall. So a lot of effort's been put in that regard, but I would say it's coming back slowly. But there hasn't been, like I said earlier, there hasn't really been a big push to grow production. Brian and I have both talked about the Clearwater. I would say that play itself is somewhat unique within the Western Basin and probably North America overall. But other plays are really just staying flat and keeping qualified and good and engaged staff that are working on those assets is really key.
It is. Okay, Brian, I have to throw one more question to you. Even though we're in a time of finding efficiencies and cutting, we're seeing the oil and gas companies really having to add new commitments when it comes to ESG, First Nations agreements, that sort of thing. Do you think this poses new opportunities or perhaps new challenges as well?
You've really seen, I was at CERAWeek in March, and that's typically where they talk about energy transition and where we're headed. And that whole conference got turned up on its head because of energy security. Now, I think that, we put a lot into ESG. We've cut our emissions per barrel intensity quite substantially. And that, along with Indigenous and our ARO program, qualified us for the first sustainable bond in North America, which for an energy producer, which is really quite an achievement. So I've been watching this unfold, and what kind of benefits are you going to get because you're in ESG? It's always a question that we're asking. Are shareholders going to drive your stock price up because of it? No, I don't think so. I see no evidence of that whatsoever with any of the companies that put ESG on the table. But I am seeing it a little bit through the banks now. I'm seeing that our lending capacity is, they're more willing to lend to us because we have that bond and we've qualified for it. And I think that helped us with the Delta Stream debt picture because a number of the banks are pulling back in that area. There's things like Mark Barrels and other things that I see coming around the corner, none of which add a great big prize to oil companies, but nonetheless, I think is a sign of the future and where we're headed.
Okay. Anything you want to add there, Rodney?
No, I'd add that, just like Tamarack and Brian are doing, and the industry itself is really working to, reduce the environmental footprint, whether it be surface access locations or emissions that we generate. Baytex, we've reduced our GHG emissions by over 50% from 2018. In fact, have a target of 65% reduction by 2025. We've got a target to abandon and reclaim over 4,500 inactive wells through our active ARO program by 2040. Maybe piling on to what Brian said, the global need for energy and perhaps the spotlight that the Russian-Ukraine war has put on this, and consider what the industry is doing for emissions, water use, carbon abatement, and not to mention diversity and inclusion. Especially Indigenous groups, it's hard to imagine that sentiment towards the industry and in particular the Canadian energy industry shouldn't be improving.